Net profit plunged 57.4% year-on-year to 1,184 million Singapore dollars. While management is popping champagne over record revenue, your actual dividend income just took a major hit. Today, we look past the headlines to see if your retirement capital is actually safe. I have been watching this one for a while, and the number that finally made me sit up was that massive statutory profit collapse. My job is simple, even if the balance sheet is not. I read the numbers that the headline skips: the interest coverage, the gearing, the free cash flow sustainability, so that the Singaporean building or living off a dividend portfolio gets the same forensic clarity that institutional money takes for granted. Looking at the top level, we see a massive gap between the headlines and the reality. Management celebrated loudly because total revenue hit a record 20.52 billion Singapore dollars. But for those of us holding this for passive income, the net profit collapse of 57.4% is the only number that matters. On a $50,000 holding, that translates to a loss of $877 in annual income. It is the profit collapse behind the record revenue that we need to audit. This audit matters because institutional money does not just read the front page. They look at interest coverage, gearing, and free cash flow first. We are also looking through a forensic lens at two hidden factors. First, the lag in jet fuel costs means the real pain has not even arrived yet. Second, we have the structural accounting choice regarding Air India, which buried 846 million Singapore dollars in integration costs. We need to know if these are one-off shocks or a new normal. Turning to the operating picture, the numbers look impressive at first glance. Revenue reached a record 20.52 billion Singapore dollars, up 5% year-on-year. The group passenger load factor also hit a record 87.7%. Fewer empty seats burning expensive fuel. That is the right direction. Even Scoot is pulling its weight with a 90.4% load factor, effectively helping to subsidize the broader group capital expenditure and protecting your dividend pool. But there is an invisible tax on your investment returns that you need to watch. Passenger yield is flat, which tells me the airline is losing its pricing power. At the same time, unit costs excluding fuel are rising 5% to 6.3 cents. When costs go up and you cannot raise prices, your margins evaporate. Cargo offers a small 4% relief in unit costs, but at 19.4 cents, it is only a modest buffer against the rising passenger costs. We also have a productivity warning to consider. Value added per employee dropped 15.1% to 290,561 Singapore dollars. When headcount costs rise faster than value creation, that 37-cent dividend starts to look threatened. On the bright side, the conversion of $850 million in bonds by November 2025 removes the dilution risk. This gives us much clearer visibility on the income available for distribution. Here is the fuel lag that nobody is talking about. The headline operating profit you see today is not the profit of the year ahead. It is the profit of fuel contracts signed 18 months ago. Management practically whispered that the recent Middle East conflict fuel spikes were only partially reflected in these March 2026 costs. When the full impact of these geopolitical spikes feeds into the next financial year, we expect operating margins to compress violently. Before we move into the valuation, if you want this level of forensic depth before the market opens, join Iggy's Elite Investors. You get 0-day access to my breakdowns and the full red zone watch list so you never get caught as the exit liquidity. Link is in the description. Looking at the reality check on valuation, the current price is $6.27. Investing Pro's consensus model sees a modest 4.6% upside, but the range is massive, running from $2.86 all the way to $8. Morningstar is more cautious, implying a small downside. The stock is not obviously mispriced, but the forward earnings compression is the real risk here. And this is the tool behind every number I just walked you through. Investing Pro's 15 model consensus puts fair value at $6.56, a 2.8% upside from the current price of $6.38. The range runs from $3 all the way to $8, which tells you the market has genuine disagreement about where this stock is headed. 14 analysts are clustering around $6.51, so the consensus is tight even if the model range is wide. What I find more interesting is the financial health breakdown. Cash flow scores a 3, growth scores a 3, profitability scores a 3, relative value scores a 4. That is actually the strongest reading on the board. But price momentum scores a 2, which is the market telling you it is not convinced the recovery is real yet. When relative value is your highest score but momentum is your lowest, you are looking at a stock that is cheap on paper, but the smart money is still sitting on its hands. The 5-layer margin breakdown shows the real danger. We are seeing margins compress from 8.7% down to 4.7%. That is below the pre-pandemic average of 6%. While some peers are managing their margins better, Singapore Airlines is failing the sustainability test on a forward basis. Morningstar projects net profit falling to approximately 900 million Singapore dollars in the next year, below pre-pandemic norms, and lagging behind the trajectory of competitors like Cathay Pacific. Think of it like buying a resale HDB flat. You might pay a premium because the flat has fresh paint and looks beautiful today. But if you know the lift requires a major upgrade next year that you have to fund, the true value is lower than the asking price. The market is paying for the fresh paint of record revenue today. The forensic investor is already pricing in the upcoming lift upgrade of expensive fuel costs and margin compression. On the yield spread scorecard, the asset yield of 5.58% still clears my forensic floor of 4.7%. Even with 6-month T-bills at 1.4%, I keep my standards high because I audit for the storm, not just the sunny days. The stock technically passes on current income, but when it comes to net profit growth, it is a strict fail. We are being compensated for risk, but the margin of safety is thinning. Looking closer at income sustainability, the dividend yield of 5.58% is a pass for now. The 57.4% drop in net profit and the declining price-to-earnings ratio are major red flags. The price-to-book ratio stays relatively flat at 1.26 times, but the quality of the earnings supporting those dividends is clearly under pressure compared to the prior period. Every stock goes through my forensic zone system. While the yield technically crosses the threshold for Zone 1, the massive profit collapse and the strain on management credibility keep Singapore Airlines in Zone 2. It is a watchlist name, not a conviction buy. To move back to Zone 1, we need to see evidence of actual earnings recovery, not just a high headline yield. We are watching this one very closely. The forensic verdict on debt health is a bright spot. Gearing is at 26.7%, well below my 35% threshold. Interestingly, the company earns more on its cash holdings than it pays on its debt obligations. For an airline, this positive net interest position is a position of significant structural strength. It means the interest coverage ratio is not currently a binding constraint on their operations. The balance sheet is structurally sound, clearing the forensic ceiling with room to spare. Having positive net interest is unusual for the airline industry and provides a real cushion. There is one unresolved item though. The presentation deck gave us nothing on debt maturity or refinancing timelines. Any investor looking to accumulate shares should verify these timelines first to ensure there are no hidden liquidity crunches on the horizon. In our scenario analysis, the base case has a 50% probability. Geopolitical tensions stabilize, but margins still compress as pricing power evaporates. The bear case at 35% sees profit falling below $900 million and your dividend being slashed. The bull case is the outlier at 15% and depends on the Air India integration finishing early and competitor capacity remaining constrained. These are forensic estimates to help you size your risk. Here is where my concern shifts from the numbers to the people running this company. Management previously flagged that the decline in yields would moderate and the net profit still collapsed by over 57%. A big part of this was the accounting choice to shift the Air India equity accounting duration from 4 months to a full year, which buried 846 million Singapore dollars in integration costs that management had previously downplayed in their narrative. When management changes the goalposts to explain away a massive profit collapse, the forensic auditor stops listening to the story. That $846 million Air India loss is not just a one-off shock, it is an accounting choice that distorts the bottom line across reporting periods. We have to be aggressive in discounting their forward earnings guidance when the narrative does not match the statutory reality. The forensic verdict is this: the stock passes the hard gates for yield, gearing, and positive interest, but it fails the profit test. The 57.4% statutory collapse is significant. The Air India drag is structural, and the fuel lag is still unresolved. This keeps Singapore Airlines firmly in the Zone 2 watchlist category, an income play with a very visible cloud on the horizon. The core tension is straightforward. The 5.58% yield looks safe today because the balance sheet is solid and the stock is not expensive. But the Morningstar bear case of $6.10 is not a fringe theory. It is the logical output of the margin compression we see coming if the next year of fuel costs arrive as the hedging data suggests they will. The single most important takeaway from this entire audit is that record revenue is masking a structural profitability crisis. Net profit could fall another 24% from here. You have to ask yourself, is a 5.58% yield sufficient compensation for that kind of earnings risk? Revenue does not pay dividends. Sustainable net profit does. And right now, that profit is trending the wrong way. If management is perfectly comfortable watching net profit drop by more than 50% while celebrating a revenue record, are you perfectly comfortable trusting them with your retirement capital? This is the fundamental question every Singaporean retail investor must sit with. Do not let the glossy photos of planes distract you from the hard math of your own wallet. You should not be reading these red zones alone. Join our community of elite investors to get the full forensic picture and institutional-grade cheat sheets before the market opens. For $9 a month, less than a kopi and kaya toast set at Raffles Place, you stop being the exit liquidity and start seeing the flags before everyone else. Link is in the description. The yield passes and the debt is manageable, but the profit and credibility are failing. This remains a Zone 2 watchlist stock. The forensic flags are waving, and now the choice is yours. This is the framework that puts everything we just covered into a single picture. 5 zones, 1 verdict. Singapore Airlines sits in Zone 2, watch list. The check mark tells you exactly where we are. To reach Zone 1 fortress, you need a yield at or above 5.5%, gearing below 30%, and an interest coverage ratio above 5 times. Singapore Airlines clears the gearing and interest coverage thresholds, but the yield at 5.58% is right on the boundary. And the profit collapse means we cannot treat that yield as structurally secure. Zone 1 requires 0 soft flags. This name carries at least 1, and the earnings trajectory is moving in the wrong direction. Zone 2 means monitor closely, not avoid, not accumulate aggressively. Watch, verify, and wait for the next earnings cycle to confirm whether the profit recovery is real or whether management is papering over a structural problem with optimistic guidance. The good news is this stock is nowhere near Zone 3, 4, or 5. The balance sheet is genuinely clean. But clean debt does not rescue a collapsing earnings line, and that is exactly what we are tracking into the next reporting period. Zone 1 or Zone 2 is the only territory where CPF and SRS suitability even gets considered. Singapore Airlines is eligible for that conversation, but not yet. The profit test has to pass first. I am Iggy, forensic investor, ranked 8th on Tiger Brokers among Singapore retail investors, and your guide through the SGX market jungle. If you want the full breakdown before the free version drops, Iggy's elite investors get 0-day access. Link in the description. This content is produced for educational and informational purposes only. I am not a financial advisor. I am a retail investor who applies forensic analysis to my own portfolio and shares that process publicly. Nothing here constitutes a recommendation to buy, sell, or hold any security, and no specific target prices or personalized financial advice are offered. All data is sourced from public filings and verified sources. Where data is unverified, it is explicitly flagged. All investments carry risk, including the potential loss of principal, and past performance is not indicative of future results. If you are making investment decisions involving CPF, SRS, or personal capital, please conduct your own due diligence or consult a mass licensed financial advisor before committing funds.